upswing, and have seen a huge upswing post, having deep drawdowns in 2018 and 2019. So some portion of this performance is also attributable to the emergence of new sectors and new leaders in the mid-cap space. So to put more light on such opportunities, we have Anant, Jalan, and Nimesh Mehta from ASK Investment Managers. Anant is a portfolio manager at ASK. Anant has had a total work ex of around 15 years and has spent most part of it around 10 years at Goldman Sachs. He's been responsible for managing money and covering various sectors and companies globally. Nimesh, on the other hand, heads the business development and products at ASK. Nimesh has had over 2 decades of experience and has also authored one of Amazon's bestseller books called Sales Booster. So with this, I'll hand it over to Anant and Nimesh for their thoughts on the market and also an overview of the ongoing fund opportunity at ASK.
Thanks, Akshay. Hi, everyone. Nice to be here, speak to you. I'm just going to run through a quick presentation that will just touch on the key highlights of the offering, and then we'll try to leave more time to answer all of your questions. So I'm just going to load this presentation. Akshay, can you see it? I'm just going to make it full screen.
Yes, Anant. Yeah, better if we can make that full screen.
Yeah, perfect. The first page, yeah. Sorry,
yeah, great. So we're here to talk about ASK Emerging Opportunities Fund. It's a new AIF that we recently launched, and the AIF will focus on, it's a flexi cap offering with a mid cap bias. As we go along, we'll highlight kind of the investment philosophy, the strategy, what kind of companies we'll be investing in, etc. A little bit about ASK. You're familiar with us, so I won't spend a lot of time. We manage about 30,000 crore plus AUM. We only do equities. The investment philosophy tends to be, growth quality focus. That's what we've stuck to since inception. And in terms of risk reward, we always look for preservation of capital in addition to the appreciation in capital. So this is an important slide that talks about the investment philosophy that we follow as a house. So across our strategies, any stock that goes into the portfolio needs to have these attributes. So what are these attributes? The first attribute we look for is size of opportunity. So here we are looking for companies that are in industries that are growing. So if the industry itself is growing, that means the size of opportunity is growing. Within that, if the company itself benefits from a market share shifts such that the company itself can grow faster than the industry, that's an added bonus. So we'll talk about some of those examples. What do I mean by that as we go along? But size of opportunity is very, very important. Quality of business. So again, here we are looking for companies that are competitively advantaged, that can take advantage of the growth opportunity in a capital efficient manner. So growth does not translate into value creation, but when you have growth coupled with a competitively advantaged business that has moats around it, that can generate high incremental ROCE, that's when growth sort of translates into value creation, and that's what we're looking for. So sustainable businesses that have long-term moats around it. In the middle, we have good management, which is extremely critical, probably the most important factor when we look at investments. Just like we are stewards of people who invest in our fund of your capital, similarly, we hand over the capital to companies and they allocate that capital for us. So we need management not just to be ethical, but also to be competent, to know what they're doing and take advantage of the opportunity. So when you have size of opportunity, quality of business, and good management, that's when you have compounding in earnings. And compounding in earnings is what sort of generates wealth for investors over the long run. And of course, we need to buy any company or any stream of cash flows at a reasonable value. So we have to have a margin of safety that ensures that the companies compound and investors compound their investments as well. So as I mentioned, this is a flexi cap portfolio with a mid cap The idea is to buy leaders in industry. So, we're not a sort of a mid-cap fund where we're looking to buy a mid-cap for the sake of buying a mid-cap. We want to buy companies that are leading or best positioned in any industry. Some of these companies tend to be mid-caps today because the industries themselves are emerging. We'll come to examples. For industries where we think larger companies are better placed. Some that come to mind are insurance or some financial services, including consumer lending. Where we think of Bajaj Finance may be better placed. In life insurance, it's a promise you're making to policyholders that you give me the money today, and I will take care of your family if something happens to you, 15, 20 years down the line. So if it's a small company, that promise doesn't carry a lot of weight, but the bigger companies sort of have an advantage. And so for spaces like that, we will not want to buy sort of the mid caps. We will want to buy the large caps. So we always want to buy the leading company in any industry theme. So that's why up to 40% of the portfolio could be deployed in larger caps. And the philosophy sort of remains the same. So any company we put in the portfolio, we would want to own it in any of our other portfolios. So it has to meet the investment philosophy characteristics. We're not just going to buy it just based on the market cap filter. So these are some of the examples of industries today that are emerging, and where the leaders in these industries happen to be mid caps. They are clear leaders. They are, but they are mid caps. So the first example would be kind of something that we're seeing in manufacturing. So, India has lost a lot of its manufacturing to China over the last 20 years. China has subsidized manufacturing and has built scale. And with scale comes cost efficiencies and cost competencies. And because of that, China is pretty much 50% plus of most global supply chains today. And for the right reasons, because they can provide material at a far lower cost than anybody else. But I think we're seeing a reversal of that trend now, where for various reasons, buyers around the world, particularly in the Western world, are looking for alternatives to China. They don't want to depend on one country for their entire supply chain requirements. They have seen during COVID, what disruptions to supply chains can mean. And if you're dependent on one region or one country, it is not very, very prudent. And so that's why you're seeing more and more examples of companies looking to diversify their supply chain requirements and looking for a second source or a third source, even if it means paying a slightly higher cost today. And so countries like India sort of stand to benefit from that shift. China itself is focusing less on sort of, the lower value manufacturing. As China has evolved economically, priorities have shifted, priorities are different, and they're no longer focused on, what they were focused on 20 years ago. And so what all of that means is that for companies that are manufacturing in India, the size of opportunity or the growth headroom has really sort of picked up over the last few years. And in areas like chemicals, APIs, even electronic manufacturing, we are seeing companies like Aarti, which is a leader in the benzene chemistry space, PI, which is kind of a leader in the agri contract research and manufacturing space. And so, these companies are leaders even before the shift from China. But what the shift from China or the China plus one means is that despite them being leaders in what they're doing, there is room now for them to add new products, add new adjacencies. And so the growth rate, sort of medium to long-term growth rate potential for these companies has certainly improved. And so that's one example sort of where, the industry itself is emerging and even the leading companies are mid-cap. Similarly, sort of in the consumer space, unorganized is a big part of India still today. And particularly in certain sectors like diagnostics, footwear, that tend to be pretty fragmented, where the organized sector is kind of 5, 10, 15% of the overall industry. But within that, so the companies that are leaders, like Metropolis is a leader in West India, Relaxo is a leader in the open footwear space. These companies are still mid caps. And despite them being kind of sub 5% market share, today, we think over time there's a clear trend where larger companies, organized companies are benefiting at the expense of smaller, unorganized competitors. We've seen a number of shocks, right, over the last few years. We've seen demonetization, then we saw GST, now we've seen COVID. So all of these shocks have really hit the smaller, weaker, unorganized players a lot more. And, at the competitive positions of these organized players has improved manyfold. And what you're seeing is that these industries themselves are growing. For example, diagnostics, with better awareness, better affordability, people are more focused on prevention. And so the diagnostics industry, of course, is growing at a healthy rate in India. But within that, organized players like Metropolis are gaining share and so growing even faster. Similarly, from the digital theme, which is kind of offline to online, 10 years ago, pretty much everything in India was offline. The internet was something that was available only to kind of a privileged few. Broadband costs were high, smartphone prices were high. Over the last 3-4 years, with the advent of Reliance, Jio, and scale, what's happened is that pretty much everyone in India today can afford broadband, can afford a smartphone. And, given India as a young population, affordability was the only sort of gating factor. With that having been taken care of, we've seen a big adoption of broadband and of smartphone usage. And so what that has meant is that it's given a big tailwind to the offline to online shift. COVID, of course, has been a big help as well. Until COVID, there was a large segment of the population that was very comfortable kind of doing things offline the way they have been used to over the years. But COVID forced them to adapt because a lot of offline was shut. The way to order things is only through Amazon. And so what that meant is a lot of people were forced to adapt and forced to try these digital mediums. And, I think with the convenience of digital, which is, better experience at a better cost, means that this shift is going to be permanent. People who have tried this, most of them are going to be permanently shifted. And so this is in a very early stage of migration. Most things are still offline in India. And if you look at the leaders in for example, ad tech company like Apple, IndiaMart, which is a leader in the B2B classified space, these are still mid-cap companies, despite them being sort of leaders in what they do. And that's because the offline to online journey itself is in its infancy. And so these industries themselves are just emerging. And because of that, even the leaders sort of happen to be mid-caps. I think this is an important slide that kind of differentiates one mid-cap from the other, or one class of mid-caps from the other. So as you know, mid-caps in general have had a tough time over the last 3 to 4 years. We've had these shocks of demonetization, GST, COVID. The macroeconomic situation or growth has not been particularly great because of that over the last 3 or 4 years. And mid-caps in general being somewhat more marginal in that sense. You can see the first black line over there, the minus 3.2%. That's the earnings growth for the mid-cap 100 universe as a whole. So no growth basically from FY18 to FY20, which makes sense given the macroeconomic backdrop. I think what's more important is, the mid-caps that are leaders, which is sort of ASK as a house, we're quality focused. So the mid-cap companies we focus on, which is less than 40,000 crore market cap, which is part of our investable universe, which is in gray, even in this period of poor macroeconomic growth, has been able to grow, at 18%. And within that, the stocks that we think are leaders and will be part of this portfolio have actually delivered 28% earnings compounding. So I think what this goes to show is that even in a tough macro environment, which have not been very supportive for broader economy and mid caps, category leaders have had a more secular growth journey, and that is showing in kind of the earnings compounding, over this period. And I think the market has rewarded it, right? So if you look at, this is the stock price performances of companies over the last 3 years, which have been a tough period for mid cap, and the index has been lackluster because of that. Companies like Bajaj Finance, Dixon, APL, Apollo, Metropolis, IndiaMart, Radico, Solar have all delivered superior earnings growth, and the market has rewarded that with superior stock price performance. This is just a slide that shows kind of IEP, which is our sort of flagship scheme today, our biggest scheme in terms of AUM. When we started IEP 8-9 years ago, we were picking mid-cap companies then. They were leaders, again, quality, just like we are focusing for EOF. And they are today's large caps, right? So these are household names today. We go through some of these. Example, Pidilite, Astral, PI, Bajaj Finserv, Bajaj Finance, Page, Asian Paints, Chola Finance. These were all sort of mid-cap companies when we started buying them in IEP. They are still part of, most of them are still part of IEP portfolios today. But the point I wanted to make is that, when we were buying them 8-9 years ago, when we started buying them, they were mid-caps, they were emerging. And today they are kind of blue chips that pretty much everyone, who's involved in the markets heard of, part of most portfolios. And, we are hoping that EOF will have a similar kind of journey, looking forward. A little bit quickly on the fund construct. So we will construct this as a 25 to 30 stock portfolio, somewhat equal weighted. There will be, few stocks that will be bigger, higher weightage, but it will be pretty equal weighted. Of course, we will have all the filters that we have in place for ASK. We start with the entire universe, then we make cuts on management quality, industry, etc. And then we run quantitative filters such as return on capital, earnings growth, etc. So that gives us a smaller investable universe from which we pick 25 to 30 stocks that we feel offers the most superior prospects from a risk reward perspective. From a portfolio perspective, again, we will have no stock, of course, can be more than 10% of the portfolio. And even from an industry diversification perspective, we will have judicial sectoral diversification. A little bit on the structure of the fund. So it's structured as a 5+2 year fund, AIF, close-ended. We will be doing the drawdowns 30% on the initial close, and then the balance 70% will be drawn down over the next year, probably 35% kind of in February and 35% in July. The lock-in this will have a 2-year lock-in from the final closing. And between year 2 and 5, there will be a nominal penalty if investor wants to withdraw. The thinking here is, again, we think for equities, a long-term horizon is required. 5+ year horizon at a minimum is what we look for. And so that's the reason we've structured this fund as such. This is the fee structure. So thank you. I'll stop there. I'm sure there'll be lots of questions, so would rather sort of leave time for Q&A. Nimesh, you want to add anything? Sorry.
Thanks, Anant. Yeah, Nimesh, if you would like to add something on the fund structure.
So I'll just touch the last part which you said. What we're trying to do here is that we're taking about 30% drawdown currently. 2 things I'll share. The balance 35% we will most likely take in February of next year. And the last 35% roughly in about July of 2022. So that's the time I think the firm, the fund will get closed. So from then it'll be 2 years close ended. Then 3-year exit road protected, 2% in year 3, 1% in year 4 and 5, and then 2 years open ended. So the clients can decide to time their exit after 5 years whenever they would want to do that. One important thing along with the IP complementary thing which Anant touched upon, most of your clients probably may have and most of the clients will have the mid-cap mutual fund, and therefore always the question comes to their mind that should I add this in the portfolio? And I can share you that separate slide once I can do. The overlap of our portfolio with the entire equity mutual fund industry portfolio is only about to an average of 3 stocks or about 6% on an average. That means that, for the clients who are owner of HDFC mid-cap opportunity funds or in L&T or mid-cap and so on and so forth, the overlap is only about 3 to 4 names, 5 to 10% out there. Because what we do is that we are not index focused at all. We will always buy companies which, a lot of Anant covered, whether diagnostic chain, whether digital technology products, or in terms of chemical products, which we spoke about, chemical companies we spoke about. Those are names not very, I would say, seen in many of the mutual funds because they will marry the index or copy the index out there. So this actually becomes a complementary strategy to if some of them are holding a mid-cap mutual fund or, a similar type there. So I think that is where I would again stop here, and then more on the questions we will try and address when the clients raise it.
Perfect. Thanks a lot, Nimesh. All participants can type their questions in the Q&A box at the bottom of the screen. There are a few questions on drawdowns and tenor. I think that has been addressed. Yeah. Exactly. Anant, while we get questions, wanted your view on, since we are talking about emergence of new sectors, the fintech, consumer tech through Zomato has, really, and I think there are a lot in the pipeline as well, has emerged. So just wanted to know your views on the company and sector as such.
Yeah. Look, I think these are extremely exciting opportunities. We have seen the world over how these sort of platform technology businesses can scale, right? Unlike traditional businesses that, take their own time to scale, you have to set up factories, you have to set up distribution. So it happens sort of gradually over time. With these businesses, the go-to market can be extremely fast. The adoption, if the value proposition is there for consumers, can be extremely fast. And so what it means is that, growth opportunity can be huge. And, one has to look at each company sort of separately on its own merits, whether there is a right to win. But having said that, some of the companies coming public today, whether it's a Zomato, whether it's a Policy Bazaar, whether it's a Nykaa, these are clear leaders in what they do with a clear customer value proposition. And while the profitability doesn't look as clear today, I think one has to look at sort of these kind of companies. You have to look at it a little bit in more nuanced manner. You have to sort of peel the onion a little bit, look at it from a unit economics perspective. Because what happens with these new age companies is that investments that these companies make are passed 100% through the P&L, right? So unlike a traditional company, if it spends CapEx, it goes on the balance sheet, and the impact on P&L happens gradually over a 15, 20-year period through depreciation. These companies don't invest in fixed assets. Their investments are in customer acquisition, customer delight, making the customers happy, getting the customers to try your product and get hooked onto it. And so these are really investments, but they are flowing through your P&L as expenses. And so naturally, a company that's growing at 50, 100% in many cases, will need to invest a lot. And you see that in even in life insurance, for example, right? The P&L paints less of a picture of the company because all the costs are upfronted and the benefits accrue over time as the premiums roll in. Similarly in this, right? Right now you're in investment mode, and so profitability will not fully reflect today what the actual underlying profitability of the business is. And so when you put all those together, size of opportunity, easy to scale and ramp up, businesses that do have superior unit economics and are adding value to their customers, we think they're extremely exciting opportunities, and we're focused on all of them.
Perfect. Thanks, Anant. Anant, we have some questions in the chat box. I'll read it out. Share some ideas wherein you are convinced at the current scenario or current market price. I think most of the ideas that we discussed through a slide, whether it be Apple or chemical companies, API manufacturers, those are ideas. But if you would like to maybe add to that.
Yeah, No, I think, look, I think we already kind of mentioned some of the names specifically in my presentation. There are leaders in what they do. So we spoke about Metropolis. This is a leader in the Western region in diagnostics. Diagnostic space itself is highly fragmented, with even the leader having kind of a 5% market share. Over time, we think, as we've seen across industries, there will be more consolidation. And so leading companies, that have not just the brand recognition, but also scale, which gives you cost advantages, which you can then pass on to the consumer. So the consumer itself will be getting, a better branded player with more reliability at a better price point. And, that kind of virtual wheel will mean that over time, the leaders will gain market share. So unorganized to unorganized, we've spoken about, again, in the global supply chain, chemical companies, company like Aarti is a global cost leader in what they do in benzene, with more opportunities opening up as China is ceding share. There will be more growth than what's business as usual growth, which may be kind of 10% plus, but because of the additional shift from China, India today, if just give you context, in the chemical supply chain is kind of less than 5% of global capacity. China is at 50. So even a small shift from China can mean, huge opportunities for the Indian companies. And so those are examples. Of course, in digital, I mentioned companies like India Mart, etc. What India Mart does is very, very interesting. It essentially connects manufacturers in around India, or even distributors for that matter, directly with the consumer. So, to give you an example, if I'm someone making a pump, and I'm in some small place in some small factory in India, 10 years ago, the only way for me to get my product out to my consumer was to find a wholesaler, find a distributor, find a retailer, and every person in the middle takes his cut. And so product that costs 100 rupees to me might ultimately reach the customer at 200 or 300 rupees, right? The huge inefficiencies along the way. What India Mart does is it connects me now directly with the buyer, right? All digitally, where the buyer can come, have a look at the specifications on a website. So it's the process a lot more seamless. And so it's a win-win for everyone. It's a win for me because I get route to market. It's a win for the buyer because instead of paying 200 or 300 rupees, he can now buy it at 150 rupees. And, that's the power of technology. And so, companies like that, extremely exciting. Apple is a player in the digital ad space. Digital ads in India today is less than 20% of total advertisements. In the West, we have already seen the penetration of digital reach 60, 70%. Companies like Google and Facebook are nothing but digital advertising companies. They have people who are spending time on their websites, whether it's search on Google, whether it's YouTube, whether it's on Facebook or Instagram, and they monetize the traffic and the time spent by people by placing ads that reach people, right? So, traditionally advertising was done on TV or on print. That's where people spend time. But if you look today, people are spending time on their smartphone, right? And on the internet. And so it's natural, and it's a matter of time before ad dollars follow the attention of the target market of consumers. And so, companies like Apple and the whole digital advertising space in India is going to see very rapid growth for many years to come because of that. So these are just some examples. I don't want to get into sort of, discussing every stock threadbare, but hopefully this gives your viewers a flavor of the kind of stocks we're looking at.
Thanks, Anant. A few more questions. Is it a buy or hold strategy as per the mid cap cycle, or will the fund move to large caps after mid cap upside is over?
Yeah. No, it's a buy and hold strategy broadly. Again, we are long-term investors focused on fundamental value, and we pick companies that we think are superior, have superior prospects from a long-term perspective. So unlikely that our view changes kind of 6 months or 1 year in. Of course, if it does, we will take action, and if there are superior opportunities, we'll look at that. But broadly, the churn levels will be low because we're buying companies with a long-term horizon. And so, it's more of a buy and hold kind of strategy.
Sure. So Anand, I'll just combine two questions. What what is your broader view on market and how much overlap will this strategy have with IP? I think that's about 40%. If you can confirm that, and also broader view on the market maybe.
Yeah. So I think on IP, you're right. There will be some overlap, maybe in the 30 to 40% range is what I would want to say. The reason there would be overlap is because there are some companies where we think the large cap is the best place. So if we want to play consumer lending, we think Bajaj Finance and Bajaj Finserv are best place. So that will have sort of overlap with IP. There would be some other examples. There may be some overlap, but broadly, IP is a flexi cap with a large cap bias. This will be a flexi cap with a mid cap bias. But the other characteristics that we look for, bottoms up companies that have large size of opportunities, superior businesses, superior management, and compounding, that is consistent across all our portfolios at ASK. So I think there will be some overlap, but I think there'll be enough differentiation that, this will be additive to that. So 30 to 40% overlap. Sorry, Akshay, you had another question. Sorry.
Yes, view on the broader market, if you want to maybe summarize.
Sure. Nimesh, were you going to add something to this?
No, continue that.
So I think the broader market, look, I think certainly what we've seen over the last year and a half is a pretty strong performance by equities in general. I think it can be explained by 2 or 3 factors. One is that we saw a pretty sharp drop in sort of the early first quarter of last year. And so, of course, if one measures from, June of last year, so over the last year, the performance looks extraordinary. But I think that's probably comparing it from a very temporary low base, which was, of course, caused by COVID. But if I was to put COVID out for a minute, because essentially COVID is the impact of COVID will be on 1 year's earnings or 1 or 2 years of earnings, whereas the value of a company is actually the earnings power kind of 2, 3, 4 years out and in perpetuity. One has to sort of look at it in that sense. And so from that perspective, the markets are up. I would say from January of last year are up 40, 50%. But it can also be explained by 2, 3 factors. One is you had earnings growth in that period. So despite COVID, corporate earnings have actually grown over the last year. And secondly, and more importantly, is the cost of capital or the discount rate, right? So the value of a company, which essentially drives the value of stock indices or stock market, is a factor of 2 things. One is future cash flow potential. And the second more important factor is the discount rate, or what sort of rate do you discount those future cash flows. And the discount rate has fallen pretty sharply. So, we are used to 10% interest rates in India, 5% interest rates in the West. Now, if you look at 10-year yield in the US, it is at 1%. In India, home loan rates are at 6%. If one is to look at what one makes in fixed deposits after tax, it is 2-3% in many cases. And so when the cost of money is fallen, of course the multiples the market gives to stocks has gone up, and rightly so. So I would say part of the run up has been driven by that. So that's the story what we've seen over the last year. I think more importantly going forward, the picture for earnings growth is actually very robust. We've had a pretty tough 5 years of macro in India. All these shocks I spoke about, whether it's demonetization, then GST, then COVID, and number of reforms have also happened in the interim. And so what all that has meant is that and I showed you broader mid cap index has gone nowhere over the last 3 years in terms of earnings. So the base is pretty benign. The reforms take time to start showing up in macroeconomic growth. And so I actually think looking forward, the picture for India is as robust as it has been over the last 10 years. Going forward, returns have to be driven by earnings. It's hard to see too much more re-rating driven by falling cost of capital. So I think from now on, it will be driven by earnings. And I think that's the right way. That's the healthy way for investors to compound capital. And so I think that will continue. And I think, as I had shown in my presentation, if you buy companies that are in secularly growing industries and are leaders, they tend to grow whether times are tough or when times are good. And so, as long as earnings compounding happens, we feel, over time, investors will be rewarded. Of course, the margin of safety is lower than what it was a year ago, no doubt. But we still think the outlook for equity as an asset class is extremely attractive, especially compared to some of the other asset classes out there.
Thanks, Anant. Next question, maybe Nimesh can chip in there. It's more on the structure. So, is there a merit in running the same strategy in the AIF structure versus a PMS? That's sort of a common question.
I will let Anant answer the investment side, and I'll answer this other side.
Sure.
Sure.
So look, I think the AIF is a fund structure. So, it helps fund manager to manage liquidity in many cases. So for example, in a PMS, if an investor comes in and then he redeems 3 years later, fund manager has no option but to sell all the stocks in his portfolio, whether it's, undervalued, overvalued, liquid, illiquid, pretty much has to just go out and sell. Whereas in an AIF structure, given it's a fund structure, if one investor or 5% of the fund redeems, the fund manager has other ways to manage that redemption and create that liquidity. And so, for a strategy like this, which is kind of a flexi cap with a mid cap bias, having that flexibility is a huge advantage from a fund manager perspective. So I think that's an important point to keep in mind, and Nimesh, I think, can add to.
I think that was the most important point, and that's the reason we constructed this AIF, nothing else. All I can add from what Anand said is that this is a trust level, so the fund pays the taxation, you're holding an NAV. So investor, when he gets the returns in his hand, I'll post tax and post fees. So it's become quite easier for him. And a lot of investors of ours, find difficulty sometimes to invest in PMSs because as a director of various other companies, a promoter of other companies, they cannot invest into direct stocks, which in the case of PMS happens. All the 4 audit firms or the consulting firms and all cannot invest into stocks because they need to have approval doing there. A minor cannot invest in PMS. NR cannot, in terms of technically, has a lot of documentation to do. All that becomes absolutely seamless in the case. And at this point, I would like to highlight a very important thing that in the 10 year of AIF industry, we are the first AIF manager, alternate manager, who has brought in completely paperless onboarding, complete digital onboarding. And I have it now tested. Less than 10 minutes, we are able to onboard a client. No single paper to be signed, nothing to be done. And that works wonderfully. With regards to AI, that becomes simplest documentation out there versus in the case of PMSs where you have to open DMAT and everything else, which can become challenging. But otherwise than that, I think both platforms are to be chosen by the client depending on what he wants to come in.
Thanks, Nimesh. Thanks, Anant. A couple of more questions. I think I'll add to that, and maybe if you guys have any views. Explain more in an investor point of view while deciding any promising mid-cap fund versus this scheme. While adding any mid-cap fund in the portfolio, it's a function of a couple of things. One is the investment strategy of the fund. The second would be, if you have an existing fund in the portfolio, how much overlap the new strategy that is coming into a portfolio has versus the existing strategy, and also your risk appetite and time horizon. I think these are things that one should consider before adding a mid-cap fund into the portfolio. As Nimesh pointed out, if you are having a open-ended mid-cap mutual fund in your portfolio currently, by adding this strategy, you are actually only adding to unique stocks and creating very less overlap. I think that's the merit of adding, this strategy into the portfolio. So it depends on various parameters. Secondly, how much percentage investment should be made by an individual considering risk? I think that's a question which is very particular to an investor. More so, the relationship manager can assess your risk and then suggest the actual allocation to mid caps and equities as a whole in your portfolio. So that's something that's more pertaining to your life situations and risk appetite, which I think it's a more closed door conversation that you can have with your relationship manager. Nimesh, you'd like to add something here?
Beautifully said by you with experience, and that's nice. And one must look at asset allocation when even you go with the InCred Wealth Manager or risk, relationship manager. And as what Anant in between was trying to highlight, the way it is, all the asset classes, if you look at their fixed income, negative with regards to negative growth in terms of inflation and post-adjusted returns. If you look at that post-tax, commodities, hardly we can put in terms of lot many will put across their real estate. Now, from my experience of all the real estate, I mean the HNIs I speak out there, they have more than enough of real estate, and they are, because of the accounting challenges, the taxation headaches, the illiquidity and all, people are not very happy to add more. In fact, I'm seeing more and more people exit the real estate as and when they get it. Even in the close friend circle, which I'm seeing there. So therefore, in that sense, which are, one has to really be rational in thinking that from here on, which asset class will create to me a double digit or even a higher single digit kind of a post-tax, post-inflation return. Then I think that very clearly comes out to in the case of equity. And then you should sit with a relationship manager. But I would urge, if you insist, I mean, if I were to give my personal thought, I think as Indians, we need to increase our equity allocation slowly, gradually, how, but from a 10-year point of view. I think there is a huge amount of wealth to be created in this decade, when India will really move from a couple of $1 trillion to a higher. So particularly we internally, when we talk as in office, we believe this is going to be a golden decade. I'm not, hold on to 10 years, but 8 to 12, 13 years, it's going to be one of the finest times India is there. So participate, coming across there. Maybe if you have time on your side, it's okay to have slightly higher risk. But the question was, how much should I put? If you're young, if you have lesser amount of in equity, then I think it's good time to come into equities. I'm not even representing ASK right now. Whatever InCred colleagues will recommend to you, go ahead and do that, but participate in equity would be one of the messages from the house of ASK. So I'll stop here, ASK. Akshay.
Thanks, Nimesh. One more follow-up to the question that Anant and you answered on the structure, whether PMS versus AIF. Can you elaborate the sort of delta you envisage in the portfolio? I think difficult to put a number in terms of delta between PMS structure and AIF structure, in terms of future earnings, or future returns. I think it's more to do with the flexibility of the fund manager to really pick a stock to meet redemptions is what empowers him more than anything else. But difficult to put a number there.
Yeah.
Perfect. So, I mean, we can take a last call for a round of questions if there are any on the fund, and then maybe close it. So I think we can wait for a couple of minutes if there are any questions. Otherwise, we can close. Nimesh, Anant, don't see any more questions in the chat box. So I'd just like to conclude by thanking everyone who've taken out time and attended the call. Thank you, Anant. Thank you, Nimesh, for taking out time. It's a pleasure to hear you guys and the thought process there.
Thank you. Thank you all.
Thank you, Akshay. Thank you, everyone.
Thanks.
Bye all.